Hi there, this is Aardvark Tax TV. I'm Sean Kenefick, an enrolled agent and customer service representative here at Aardvark Tax. Today we're going to talk about flow-through entities and the Schedule K-1. This video is part of a complete continuing education course available at our website, www.aardvarktax.com. In most cases, when a single person or married couple own a business, they use the Schedule C to report their income. But when a taxpayer partners to do business with someone else, or many other someone else's, or requires liability protection, there's no longer an easy way to report the income that new entity generates. To facilitate tax computation for these multi-taxpayer conglomerates, the IRS recognizes several different kinds of entities for tax purposes. These entities include things like partnerships, corporations, and trusts. A partnership is an arrangement where two or more taxpayers do business together and split the proceeds. Each person contributes money, property, labor, or skill, and expects to share in the profit and losses of the business. Some states require entity registration for partnerships, which allows for limits of liability, but the IRS does not require these kinds of things for partnerships. The IRS does require, however, that partnerships fill out a separate 1165 tax return in addition to the 1040 tax returns that the partners individually provide. Partners in a partnership are not employees and should not receive W-2s or be on payroll. Instead, all income that is generated to the partner through the partnerships flow to the individual's tax return through a form called Schedule K-1. We'll talk more about K-1s in a moment. If you're a partner in a partnership, you're going to have to pay self-employment tax, like you would with a Schedule C. A corporation is a separate legal entity that has been incorporated at the state level through a registration process established by law. Incorporated entities have legal rights and liabilities that are distinct from employees and shareholders and may conduct business as either profit-seeking businesses or as a not-for-profit seeking business. In addition to legal personality, registered corporations tend to have limited liability, be owned by shareholders who can transfer their shares to others, and are controlled by a board of directors who are normally elected or appointed by the shareholders. There are two kinds of corporations, the traditional C corporation and the more recent S corporation. Both corporations register at the state level and receive benefits such as limited liability. But the way the corporations are taxed are different. C corporations are taxed separately from their owners. Owners receive income from the C corp in the form of dividends. Most major companies and many smaller companies are treated as C corporations for U.S. federal tax income purposes. There is a downside to being a C corp from a tax perspective. Income for a C corp is taxed at the corporate level, then again at the individual level for owners when they receive dividends. Owners who work for a C corporation are also put on payroll and receive a W-2. S corporations get around the dividend double taxation by allowing income that the corporation receives to flow directly to the owner's individual tax return, much like a partnership's income does. S corporations were designed to be closely held entities, and there are several rules that must be followed for those types of corporations. First, owners must apply to the IRS for special S corporation status. Additionally, S corps cannot have more than 100 shareholders. The shareholders must be natural persons and United States citizens or residents, and there can only be one class of stock. Owners who work for an S corp must pay themselves a fair wage through payroll and receive a W-2 for that income at the end of the year. Any monies that the corporation generates above that fair wage are exempt from self-employment taxes when they flow to the corporation owners. C corporations report income on a Form 1120, and S corporations report income on Form 1120-S. A trust is a legal instrument for holding wealth. Generally, a trust involves three quote-unquote persons in its creation and administration. A grantor who creates the trust, a trustee who administers and manages the trust and its assets, and then a beneficiary who receives the benefit of the administered property in the trust. In some cases, such as a revocable living trust, one person serves as grantor, trustee, and beneficiary simultaneously until they die. In other instances, especially in an inheritance after death, there will be different persons named to be trustee or beneficiary. Trusts report income on Form 1041. When they file the return, they use a Schedule K-1, like S-corps and partnerships, to report income for the trust beneficiaries. A Schedule K-1 is used by any flow-through entity to report a partner's, shareholders, or beneficiaries' distributed share of income. As we talked about earlier, entities such as partnerships and S-corporations do not pay income taxes themselves. Instead, they file their tax returns as informational returns only. This return will distribute the net profits to the shareholders or partners based upon their percentage of stock or how the partnership agreement reads. For example, if you own 50% of an S corporation and the corporation shows a $100,000 profit, you will receive a K-1 for 50% of the net profit, which in this case is $50,000. You would then file this $50,000 of income on your personal tax return. Because the company itself does not pay federal income tax, the net profit is passed through to the owners who pay the income tax on their personal tax returns. K-1s differ slightly depending on the organization creating them. You'll quickly notice that Schedule K-1s have many different fields. This is because the income and losses generated by the entity needs to flow through to different parts of the individual tax return. For instance, ordinary business income from Box 1 would flow to the Schedule E, page 2, while interest and dividends would flow to the front page of the 1040 or to Schedule B. Knowing how to map these fields is most of the battle, and page 2 of the Schedule K-1 details the mapping between the fields that are on page 1 and where on the individual tax return that income or loss should flow. Luckily, most tax softwares typically does this mapping for you, so you don't have to. When using tax software, look for a screen where you can enter this information from the K-1 as it appears. Then, when you calculate the return, you'll see the income portioned out to the appropriate areas of the 1040. Here are some things to think about as we talk about Schedule K-1s. First, you may be liable for tax on your share of the entity's income, whether or not it was distributed to you. For instance, if the company sold a stock asset and then reinvested the gains into another business venture, you wouldn't see any share of the gain in your bank account, but you would still have to pay your share of the capital gains tax. This is often very troubling for tax clients who do not understand how gain is taxed when stocks are sold, for instance. In fact, you often hear the same questions from clients when they find themselves taxed for capital gains when they hold mutual funds. The funds themselves buy and sell assets and pass those gains on to the client, even though the taxpayer did not sell the mutual funds itself. Secondly, and I'm repeating this because it's an important thought, a taxpayer's share of S corporation income is not self-employment income and is not subject to self-employment tax. Any work that is done for an S corporation should be paid through a fair wage and through payroll. Any share of income that comes from a Schedule K-1 will not be considered wages and should not have self-employment tax associated with it. Third, just because a loss has been passed to you via a pass-through entity does not mean that you automatically get to take the loss completely immediately. Just as with any other aspect of income and loss, the standard rules of individual tax returns apply. For instance, if the K-1 shows your share of a capital loss to be $20,000, you can still only take a maximum of $3,000 in the current year, and then must carry the rest over to future years, just as you would if you took a $20,000 loss on a personal sale of stock. Additionally, there are other potential limitations on pass-through corporations' losses that you can deduct on your return. These limitations are the basis rules, the at-risk limitation rules, and the passive activity limitation rules. They must be applied in that order. We're not going to go into too much detail for these three rules, but here's a quick definition. The first rule is the basis rule, which states that the deduction for your share of aggregate losses and deductions reported on Schedule K-1 is limited to the basis of your stock and loans that you made to the corporation. Secondly is the at-risk rule, which says that if you have a loss or other deductions from any activity for which you are not at risk, you will have to complete Form 6198, the at-risk limitations form, in order to figure out your allowable losses. The third rule is the passive activity limitation rule. The passive activity rules are the same as they would be for individual returns and are discussed in a different video. This video has been part of a tax continuing education course available at www.aardvarktax.com. The course has been approved by the IRS and state governing agencies like California's CTEC and Oregon's Board of Tax Practitioners. But just viewing this video is not going to get you credit. So be sure to register for this course or any other of our many courses by heading over to aardvarktax.com, and once you take the course, we'll report your successful completion to all the government agencies as necessary.